Here's what's coming up on today's show.
Think about it this way. You've got a bag of seed in the right hand and you're looking at a whole field of corn in the left. Well, the field of corn came from that bag of seed, so now you're asking, which one of these do I want to pay the taxes on?
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
We will start it with some tax consequences. Not necessarily the sexiest of things, but if you think about this, income, right? If income is king and it's number one kind of on most people's list, I would think taxes should be second, right, Craig? Because it's not what you make, it's what you keep. And obviously this can make a huge impact in how tax
on quality of life.
Yeah. So let's talk about some pros and cons, advantages, disadvantages of the different kinds of accounts that we have out there. Start with the biggies, Craig, the ones that most of us are familiar with, that most of us probably have a lot of our retirement money in, which is tax-deferred accounts.
Right. So you got to set the mental stage. A traditional pre-tax savings in something like a 401k or traditional IRA. Basically what you're saying is, I'm postponing paying the taxes today until later when I begin to withdraw my retirement savings. So if you wait, you pay me later. There was a Fram oil filter commercial that said, pay me now or pay me later.
Mm-hmm. Right.
If you're saying I'm not going to pay the taxes today, but instead I'm going to take the risk that, whatever the tax rates are in the years that I withdraw, I'm hoping that they're not going to be higher than the years where you contributed. So if you're looking at today and you're saying, man, I just paid a lot in taxes, look at the tax rate. I know that you don't spend a percentage, but you've got to look at what they charge you and say, are tax rates going to be higher in our future or not? Basically the money in your pre-tax 401k or traditional IRA, it's not all yours. And Congress will decide how much you owe of your savings in any given year. It's just the way it's going to be.
Not only that, they dictate what minimum amount you have to take out. So some people have money in those accounts that they really don't need to live on, but the government says, yeah, you got to take it out because I want some of my money back.
Yeah, they'll force you. So what's your bet for the tax rates being lower in the future or higher? I'm in the higher group. Our government owes almost $34 trillion in debt. That's just the government. They don't earn any money. They have to get their money from tax revenues. If they need the money, my argument is they'll raise the tax rates.
Mm-hmm.
So the second batter up would be tax-free. So what's that? There's not a whole lot of choices in this category. So tax-free could be something like a Roth IRA. That's where you paid your taxes up front so that the compounded growth of your money will not be taxed later when you begin using it in retirement or towards any other financial goal. Think about it this way. You've got a bag of seed in the right hand and you're looking at a whole field of corn in the left. Well, the field of corn came from that bag of seed, so now you're asking, which one of these do I want to pay the taxes on? So obviously, in my example, you'd say, I'll pay taxes on this bag of seed, and when I get my harvest later, it's tax-free. So that's basically your Roth IRA, Roth 401k options. That money will not be taxed when it comes out to you. So pay up front, and then whatever they raise the tax rates to later, okay, well, I already paid my tax when I put the money in. Other things you could use, tax-free municipal bonds. Interest rates are actually coming up a little bit. I don't know that I see a whole lot of bang for your buck on a tax-free, but at least you're not going to pay the federal tax. And if it's a bond issued in North Carolina, you're probably not going to pay the state tax either. So what you make, you keep in a tax-free bond. And then with few exceptions, you could use the life insurance strategy where you overfund and then later you can pull the money out tax-free. Those are things that you could do. But the whole idea here is how much more will taxes be in our future, and do you want to get past that now while you have earnings power and the tax rate schedule is pretty low?
And more company-sponsored retirement plans do have that Roth option where you can do pre-tax and you can do Roth. If your particular company plan does not have Roth, go to your HR department and say, can you add that Roth option? And typically, it's very easy to do. And if there's enough interest in it, the company will allow that option.
Shameful plug. Maestro Wealth does 401ks, and we would be happy to look at that structure for you and see if you can increase what you're able to do within a 401k plan.
Right.
Yeah, great point.
Another thing, when people look at, I put money in a life insurance contract or I put money in CDs, what is that and are they good? Yes and yes. CDs. Right now, CD rates are pretty darn good. I mean, it's been a long time since we've had income enough to pay attention to. If you looked at 2020, just 3 years ago, I mean, my gosh, you were earning less than half of 1% in a CD. It was embarrassing. I mean, can't make any money there.
True.
But now, I mean, you're in the 4s, 5s, for interest rates, and it's pretty good. The thing about CDs, outside of the fact that the interest is taxable, is that most of the time you're going to be under a year or two for maturity. So you make money for a couple of years. If our Federal Reserve decides to drop rates to stimulate the growth of the economy again, you might be in the same place that we were 2 or 3 years ago because the Fed controls the interest rates.
Now, I'm going to say something, Craig. So you were saying the CDs are taxable. It really depends upon what account those CDs are invested in, right?
True.
So if your CD is in a pre-tax account, an IRA, then there are no tax consequences. At that time, it's only when you take the money out. If you invested in your Roth, so people can, not that you did here, but people conflate.
That is what she's saying I did.
I know, a product versus a type of an account.
Right.
The way I like to look at it is that the type of account is like your envelope. So you've got your Roth envelope, you've got your IRA envelope, and you've got your taxable envelope. And within that envelope, you stuff it with investments and things that make you money. It could be a CD, it could be a stock, it could be a mutual fund. And so depending upon the envelope determines the tax consequences of that earning potential of that investment.
Well, no, I appreciate you explaining that because, I mean, most of us would probably just say, what is the tax consequences of my CD, right? Because we don't know any different. So this depends on where it's at, right? It depends on what kind of wrapper it has.
Where it resides.
Right.
Okay.
Right.
But it follows the rules of that particular envelope,
Investment,
correct?
Sure.
Right, that envelope.
Okay.
Exactly.
Gotcha.
And the importance of talking about all these different, we don't really talk about the taxable account very much. Mm-hmm. Let's talk about the tax consequences of a taxable account for somebody.
Well, what is a taxable account?
So a pre-tax account, you defer the taxes, grows tax deferred, and then you take the money out, every dollar's taxed. A tax-free account or a Roth is you pay your tax up front, hoping to never pay taxes ever again on any of the dollars that come out of that envelope.
Right.
Then you've got your taxable account, Craig. Talk about that.
Well, you invest your money with an after-tax savings. So you earned some money and you paid your taxes on it. And now you're saying, what do I do with it? So I can earn interest with it. I can put it in stocks and hopefully get appreciation or maybe a dividend. I can invest in real estate. But if you earn interest, with few exceptions, or if you realize a capital gain, then you're going to pay your taxes on those returns in the year you earn them. So it's a pay-as-you-go plan.
Yeah, you settle up at the end of every tax year.
So if you've got a stock, I was say, Craig, if you've got a stock and you sell it and you make money off it, that's what we're talking about, right?
Sure.
Yeah.
I mean, but there's another side to that. Let's say that you had an account with more than one stock in it. So you sold it and you made a profit, but there sits another one. If you looked at a company right now that's down, maybe Pfizer or somebody like that has gone down a little bit after COVID, and you're going, I also have this stock and it's at a loss. One thing that you can do in a taxable account, which you can't do in a tax-deferred account, is you can match up gains with losses. So in general, the rule is this. If I sell something at a loss, it negates capital gains that I've made on other things up, dollar for dollar. Now, if I have more losses than gains at the end of the year, I can carry forward those losses against future gains until I spend it all out. And so that's a good thing. And then the other side is, you've got to look at these things and say, could I gift them? Is there something I could do, say, with something that's worth, more, rather than selling it to maybe pay a charitable contribution or do something? I could gift the taxable investments, are something that you have more to work with.
So in retirement and retirement planning, you have to look at each of those envelopes, not a bucket, but an envelope, the tax consequences of that. Obviously, the best envelope is your tax-free envelope, right? That you never have to pay taxes again. Very rarely do people have all their money in Roth type of investments. But in order to create that income flow, when you're pulling money, what is the tax consequences of that draw from that account? How will that increase your income and therefore change your marginal tax rate and what you have to give to the government? It's all looking at where your money is and making sure that we develop the right income strategy to minimize the tax consequence to you. So again, you saved your whole life with this money to really support you, not you and 50,000 people on the federal government payroll, right? You want to focus on you. And that's what we try to do when we create that income plan for you and your spouse if you're married.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086. Or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.